You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskins, your host. As always, it's been a while since we've talked tax, and the only man I want to talk tax with is Carlo Bordi from Bordi & Associates. You've been on a number of times, mate, and I really appreciate your time when you do come in. Tax is sometimes the driest topic we talk about. Maybe it's always the driest topic we talk about, but it's super important to people listening in on this show, whether they know it or not, when it comes to making sure that those hard-earned gains, whether through investment or the family home, are maximised to minimising what we're paying in tax along the way. So thanks for coming in.
Thanks for inviting me again.
When we're chatting about a topic that is most relevant to listenership and also your client base, it became pretty obvious that a topic we've broached before is one that's still quite confusing to a lot of people. And I have to be honest, confusing to me too. There's so many permutations, and that topic is tax treatment for subdividing your property. Now, that might be the family home that the grandparents have owned for the last 70 years and the backyard's just getting a bit useless and let's carve a bit of cash out of that. Or it might be subdivision as a business, essentially as a profit-making scheme, as an investment, and how the ATO treats us as investors with a subdivision strategy. So that's what we're going to do today, is we're going to break it into two camps. The first camp is going to be the family home. We're subdividing the backyard off and we're doing a number of things with that, different permutations. And then the second camp, for the people who aren't interested in that, can fast forward to, hey, I'm looking to subdivide as an investment. These are the different ways we can subdivide, and these are the different ways the ATO looks at us. How does that sound?
You hit the nail on the head. Very topical issue right now.
Let's do it. All right, so let's start with the family home. We've seen a lot of it through Western Australia in the last 40 or so years, especially in the R20 space of those quarter-acre blocks that have been subdivided into simply just the family home. Might be a 3x1 or a 4x1, and then enough space in the backyard to carve that off and either pay the loan off, have some money for retirement, or simply just reduce the size of the backyard without having to leave. All of these are valid reasons as to why we would do a subdivision on the family home, and the ATO obviously treats it differently, as we said, to investors. So let's start with one of those permutations, Carlo, the easiest one if we can. We live in the family home, we're not going to leave, but we want to subdivide the backyard off and sell that as a piece of land to whoever's going to be our neighbour at some point.
Okay, let's just assume that the house is at the front and the rear block, when I say block, is at the rear. And look, this could be side by side, it's irrelevant, but just for the sake of when I'm expressing these comments, let's just talk about the rear block as being the block that is in question. The first scenario is the simplest one to deal with under most tax legislation. As long as the person's had the property for a lengthy period of time, selling that rear block is to be subject to capital gains tax, which means that you have to then take the property, the value of that land when you first bought it.
And that might have been 50 years ago, $1,000.
If it's pre-September 1985, then it's tax-free. Anything purchased after the 9th of September 1985 is subject to being under the capital gains tax legislation, and you've got to work out with a licensed valuer, okay, that portion of land that I'm now selling, what did it cost me back then? That's your cost base. And then obviously you take into account your subdivisional costs. You have to apportion those because you might put a fence in there, divide the two blocks, that's half. You might put an electricity dome, that's only for the new block. So you've got to apportion your costs, and the difference between the selling value after your expenses and what your market value when you bought it is your capital gain. You get a 50% discount on that, and that goes in your tax return. So a simple scenario that exists there.
And let's run the numbers there. Let's say we've lived in the property since 1995 in Morley. We subdivide the backyard off. We sell that backyard for $400,000 just as vacant land to a young family who are going to be our neighbours. We've apportioned the value of the backyard and all the subdivision costs to be $200,000. There's $200,000 in profit there. We cut that down to 50% straight away. We're paying tax on a $100,000 amount, and we add that to our taxable income at the end of the year.
And in most instances, it's mainly jointly owned by husband and wife, so it gets divided again by two. So there's two people with your example, 200,000 divided by 200,000. Oh, there's two of us, 50,000 each in their individual returns.
Yeah, and that might be, let's say it's $15,000 each, maybe a $30,000 tax implication across a $400,000 sale. Most people would be able to swallow that, wouldn't they?
Yeah, and look, obviously it depends on the person's tax bracket. If they're not having any taxable income that year, the 50 grand is going to cost you $8,000 in tax.
I'll quickly ask you about GST. Does GST come into the equation here if we're subdividing our backyard off? Do we need to add it or include it in the sales figure?
Now, great question. In this scenario, no. GST only applies when it's deemed to be revenue. This is capital, which means in English, it means that you're simply realising an existing asset. You're not in a profit-making scheme, so only the capital gains applies in this calculation.
Great. At the start of this, you said, and this will apply for most of this first section, we've owned the property for a lengthy period of time.
Absolutely.
How lengthy? How long does it have to be to prove that this is the family home?
How long's a piece of string? Look, at the end of the day, the tax department definition of residential property is you must occupy the property. And there's no time period normally for that unless you're into flipping properties and you do it regularly, which is different legislation. But look, most people have been in their house for, 5 years plus. Obviously, clean sailing. It's more the people who buy a property and straight away do something with it, which we'll cover that in the next session.
Is it possible that I could buy the family home, let's say, live in it for a couple of years, get on with our lives, and then we go and subdivide the property, and it's only been a couple of years, we've never done it before, and the ATO treats us the same way that someone who's owned it for 25 years?
At the end of the day, the Commissioner really looks at what is your initial intent. Now, a lot of times what's happening in Perth is that the shires are now changing the zoning to say your property can now be subdivided. Now, if you bought the property 12 months ago, unbeknown to you that was going to happen, and all of a sudden the shire says your block is subdivisible now, and you then do it, well, then the Commissioner can't say that you bought it with that intent because you never were able to do that initially. So again, every scenario is different, unfortunately, Trent.
Yeah, and that's a grey area I think the ATO has to tidy up at some point and set a date. Is it 2 years? Is it 5 years? At what point in time can we be confident that we can demonstrate that, hey, the idea wasn't just to subdivide this property, but at the same time, there are many people I know who are buying the property to do both. They're buying it for a family home with the upside of being able to subdivide it in the future. What's wrong with that?
There's nothing wrong with that. It's just a completely different tax treatment that applies. And the Commissioner doesn't really care what you do with the property as long as you pay the appropriate tax on the action you've taken.
Let's go to the second subset. We're still subdividing the family home. We're still living at the front, staying there. We're subdividing the backyard off. But before we sell it, we build a house on there. What would the difference be?
So if you're building new residential is subject to a whole hornet's nest of tax. The first thing the ATO does, it basically says this property is going to be subject to GST. You can then adopt what's called a margin scheme, and you have to remit on the settlement 7% of the gross collections to the ATO. And then because you haven't claimed back the GST when you first bought the property because it's your own house, you've got to then do your own calculation to determine, right, how much GST should have I remitted? And it's normally an adjustment that comes back to the taxpayer to their credit, some of that money. Normally 7% is too much.
Yeah, okay. So initially of that $800,000, 56,000 of that isn't going back to us. It's going straight to the ATO. And then we have to figure out of the costs, for example, the $400,000 build cost and all the subdivision costs in there, how much of that can we claim back so that we can get some of that back?
Correct.
Let's go one step further then. We've built the house, but we rent it out for a period of time before we sell it. Would there be any difference in the way the ATO treats us there?
Yeah, absolutely. The ATO have introduced a 5-year rule that virtually says if you build residential property and it's rented, then they deem it as new residential if you sell it within 5 years. So GST will apply to the transaction if you sell it within that 5-year period from when the property is completed and available to rent.
After that, it falls away.
After that, it's all deemed to be a capital gain and you're entitled to a 50% discount. No GST applies. You're clean sailing.
What happens there if we were thinking we were going to sell before 5 years? The market keeps pushing on. We decide to sell it at 7 years instead, but we've claimed all this GST in the meantime. How does that work?
Well, the only reason why you'd be claiming the GST, if your intent initially was to sell. Now, if your intent changes and all of a sudden you've completed the property and you go, I don't really want to sell anymore, under most instances, the ATO have got a clawback calculation that applies.
We're getting pretty nerdy.
It gets really crazy, yeah.
People are starting to recognise that it really is a bit of a dog's breakfast when it comes to all these different permutations. Okay, so let's move to the next permutation. We've got the family home. We subdivide the backyard off. We build on the backyard, but instead of selling that house or renting it out, we actually decide, hey, this is a lovely house. I want to live there. This is going to be my new principal place of residence, and I'll sell the front house that I've been living as the family home for the last 20-something years. Do we just transfer the principal place of residence exemption from one to the other? How does it work?
In relation to the front house that you're selling, completely tax-free under most circumstances. However, because you've carved up the block, the Commissioner now says, hang on, you've got 2 parcels of land, one that you reside on, or you were residing on for 20 years, and even though you've done the subdivision today and you've had the property for 22 years or something, it's irrelevant. It goes back to original acquisition date to work out what that block was worth. And upon putting a new house on there and then living on it, from the date that you then live in that house, it becomes your residential property. From then you can claim the exemption. But the problem lies that you've already had this block for 22 years. It takes you a year to build your new house, if you're lucky. So you now had it for 23 years. You now move into that new house and you live in it for, say, 7 years. So you've actually owned that block for 30 years. But the exemption as a new resident is only for the 7 years you lived in the house. So it's 7/30ths is tax-free.
So it's like you sold it to yourself, is what you're saying.
Is it fair? No, it's not fair. Are taxes fair? No, but that's the reality of how the tax department treats it.
That's really interesting because I think there'll be a lot of people listening to this scratching their head going, hang on, I can have a property that is CGT exempt because I live there, it's my home. I can subdivide that, still live on the back of that land, and now suddenly that backyard is not CGT exempt for the years before I lived there. That seems mental, even though that land was CGT exempt when it was a part of the front house.
You've understood the scenario correctly, and unfortunately the legislation says, yep, capital gains tax applies to that scenario. And look, the only thing you can do to reduce the capital gains implication on it, the longer you live in it compared to the longer you've owned the land, reduces the capital gains calculation.
As a percentage, you mean?
As a percentage, correct. But also, once you live in it, because it's all subject to capital gains under this percentage calculation, you need to keep all your costs. Maybe there's interest, maybe you do a renovation, there's council rates, there's water rates.
And most people would have thrown these out decades ago.
But that's what's required. Now, you can get from the council that, and you can get maybe your bank statements, but these are the sort of things that people, you're right, aren't aware of. And then when they come to do the exercise, they go, oh, I didn't know.
I think we've covered off the family home subdivision options. Let's move to the, hey, I want to buy to subdivide options. So really your first time, small time subdivision developing property investor. ATO looks at you a little less favourably, don't they?
They throw the book at you, actually. Yeah. So
things seem to have tightened up a lot since when I started doing the small stuff about 12 years ago.
At the end of the day, this is happening on a more regular basis. So the ATO are virtually saying, we look at this a lot closer. And if you're in the definition of doing this to make a buck from the day one, then GST applies. And look, there's legislation's been there basically since 2000, but it hasn't been as well known to people the way it works. And well, now the ATO are actually hunting for that, even to the point where when anyone ever sells a home, as a tax agent, we get what's called a pre-fill report, and it actually says, this property was sold. Is there any capital gains associated with this property? So they know they know your settlement date and they know your offer and acceptance date. And they ask us the question, ask your client whether this is subject to capital gains or any other profits tax.
We've become entities, haven't we, really, that are running a profit-making scheme rather than a backyard hobbyist subdivider who makes a buck on the side carving up land.
Look, to a degree, it all depends on what you do and how you do it. To answer your question initially, if you purchase a property very short term, and that could mean like you're still in the offer and acceptance stage, it's been accepted, but settlement hasn't happened yet, and you put an application to the shire to say, hey, listen, I want to subdivide this block and sell it straight away.
Which is what I would do back in the day?
Well, you do it now. Sometimes people can't afford to build their own houses, the cost of building. So what they're doing is they're buying these subdivisible blocks, they're carving off a block, they're selling it, getting some money to fund the building of their own residential property.
So let's look at those options, right? The first one, I think, and we'll run with that one into more detail, is let's say that I'm not specifically buying a property because I'm a developer, but market's moved, it's gotten expensive. I'm looking at different ways to be able to get myself and my family into the nicest area possible. I really can't afford to keep a Californian bungalow on a quarter acre in Wembley. What I might be able to do is buy it, subdivide the backyard off, sell the backyard, and keep the front house. I could probably afford that. How does the ATO treat you there specifically?
They look at that as a profit-making scheme. They say full profits tax applies, and no discounting, and GST applies on the sale as well.
Okay, so we're staying in the front house, but really what the ATO is looking at is going, look, hey, it is your family home, but before it was your family home, it was actually really a profit-making scheme. Yeah,
this mainly applies to scenarios where people are buying this property and in very short term, carving up the block, fully knowing that they can do that, and they do it with the intent of making a quick dollar to fund their next project.
So the difference in treatment here really is that you're paying GST, whereas the family home person wouldn't have been paying GST with the block at the back being carved up. And also you're not getting your capital gains discount. You're not getting that 50% off on the tax of the profit you may have made there, or the saving you've made, I guess, on carving up that backyard. So you're being treated like a business, essentially, aren't you?
You can say that, yes.
Businesses don't get a CGT discount, and businesses do pay a GST. So even though you've bought this in the family name, you're living there, you'll be getting an exemption on the house that you're living in if you sell it in the future. That back block is being treated like a business.
Yeah, and the problem with that legislation is that a lot of people don't realise that this is the way it works. So what happens there is that when they sell their property, if they don't document on their offer and acceptance and tick the right boxes, the GST associated with this is horrific. You could be paying $10,000, $20,000, $30,000 extra in GST if you don't tick the right box.
So let's be specific about that. We're talking about the offer acceptance form. Halfway down the first page, there is a one-liner with a box on the right-hand side, and it essentially says, is the sale of this property subject to GST? And if you don't tick it, it's automatically no. If you do tick it, yes, you then would have an annexure at the end of the contract and says how you believe the GST should be treated. Is it margin scheme? Is it full GST being paid, right? And that obviously allows the ATO to understand how you believe you're going to go about paying GST. But if you don't tick this box and you've got one chance to do it, then even though you may be able to be receiving the margin scheme, you may be able to have, I guess, a discounted GST outcome. Sorry, mate, you didn't tick the box. Full GST applies.
Exactly right. And it's just that one-liner. If you get that one-liner wrong, it's an expensive mistake.
So if you are out there and you're thinking about subdividing a property, whether to live in, whether one that you're going to live in, or one that you're simply just doing as a bit of a side business, make sure that when you are selling that property and signing that offer and acceptance, that you are registering that contract under a GST margin scheme situation. If you don't, you're trying to avoid GST, whatever it is, I shouldn't be paying GST, I waited 12 months, all these sort of misnomers that people have about the way that the tax system works, you will get caught and you will be treated quite roughly by the ATO.
Oh, look, even to the point where a lot of people try to use the argument, I have to remit GST if I'm registered for GST. Well, that's incorrect, because what the Commissioner says is that you need to remit GST if you're registered for GST or required to be registered for GST. So in this case, you might be oblivious to the fact that you are going to have to remit GST on this transaction and then get caught out.
Yeah, so have a good accountant. Ignorance is not an excuse.
Or what I told all my clients is, especially when they are doing this sort of scenario, is just flick us the contract and we can quickly look at it, because unfortunately a lot of agents who help you sell the property, well, first of all, they're not licensed to give you tax advice. And if you ask them, and if they get it wrong, well, then the consequences are that you're going to still wear the consequences of this, because it's a real problem scenario.
Yeah, and to be specific here, you sell a $400,000 block, your GST on that after all costs might have only ended up being $15,000, $20,000 after all costs, right? If you don't tick that box, you will pay $36,000 in GST,
which is 1/11 of the total sale value, correct?
Yeah, so it can hurt, that missing that one tick box.
Big cost, yes.
And to be frank and transparent with everyone listening, Carlo will remember one of my first ever subdivisions a long time ago in my early 20s, and I didn't tick that box, and I've always learned that lesson since then to make sure that box is ticked. Carlo, let's move on to subdividing for profit, but we're also building on top of that as well. How does that get treated?
So when you build a new residential property, it all depends, it all boils down to intent. What are you going to do with it? In your example, Trent, are you going to keep it? Are you going to sell it? What are you going to do with this property?
In this situation, I'm looking to simply do a duplex subdivision build. I'm creating two properties where it used to be one property, and I'm going to sell them straight away.
Okay, so what that means is it's still a profit-making scheme. You're required from the beginning to register for GST, which means that every bill that you get that's got GST on it, you can get back that GST. And then upon selling the property, you then have to remit GST either on the full GST component or under the margin scheme, depending on how you purchase the land.
What does that mean?
So if you're buying it from someone who's registered for GST and they charge you GST, then you can get back that GST on that acquisition. So if you buy it from a builder or someone, they're normally registered. Compared to mum and dad, you buy it from individuals who are not registered for GST and it's not their business of doing this sort of stuff, well then you can't get back the GST, but then you apply the margin scheme.
And that would be most situations, because most of us buying a property to subdivide probably buying it from a mum and dad.
In most instances, that's the case. That's why this margin scheme knowledge is so critical.
Now let's move to that last situation where buying to subdivide, we build and we plan to rent this out, have a long-term portfolio. We own these two properties for the next 10 years, and in 10 years I decide to sell.
That's a far cleaner exercise. So you don't register for GST, you don't get back any of the GST. When you sell the property later, you don't have to remit any GST. There's no margin scheme box to be ticked. There's nothing like that has to be done. It's simply a capital gain, which will then be subject to whoever owns the property getting a 50% discount on the profit generated from that sale.
So really, the ATO system really does lean towards providing the most assistance in the tax space to people who are looking to create land supply, build a house on it, and rent it out long term. You really get treated the most tax efficient way by the ATO in that long-term property investor landlord situation, don't you?
Yeah, look, the clock to look at is that 5-year clock. If you're showing that you're keeping it long term, and obviously the ATO are using this 5-year clock saying that's long term, after 5 years, you're entitled to these concessions. And
for everyone out there listening, it is something that I think you should consider. A lot of people looking to minimize their time horizon on their development. Certainly, I've done that for a long time in the past. You just don't know where the world is going sometimes. But if you're looking to really squeeze every inch out of that lemon, make sure you've got the most tax efficient setup in terms of your property development, and you have a medium to long-term horizon about your investments, it does make sense to think about that 5-year cut-off period. If you can keep that property or have a horizon of 5 years for those properties that you've developed, rent them out for 5 years, then that will be the way you're keeping the most profit in the bank at the end of the day.
Most definitely, Trent. And the most important thing with all this is really understanding and knowing your intent. Because if you get your intent wrong and you have to change your mind, it's going to cost you extra bucks, whether you have to give back GST, whether you get penalised, whether you don't get the concession. So the intent governs how you apply for your applications for GST or not GST, or whether it's going to be subject to discounts or not, and that follows right through.
Just a quick fact check there. 5 years, is that from when the build is finished or from when the title of that block was first created?
From when the property is completed and available to rent.
So that may be more like a 6 or 7 year time horizon from when you first started that project.
Yep, it's now available to rent, and that's when the clock starts ticking.
Carlo Bordi, Bordi and Associates, thank you so much for your time chatting today about all those permutations for people looking to make a buck, either carving their backyard off or doing a small scale subdivision. I know that's a lot of people listening to this podcast, and I can promise you that even the most sophisticated people don't get this right. So hopefully people can rewind this a few times and understand the spectrum of ways the ATO is looking at us these days.
It seems like a very simple exercise when you do it, but when you go to nuts and bolts and look at the tax side of it, it's so complicated and daunting. Our tax system is really horrific.
We'll leave it at that. Thanks, Carlo.
Thank you.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!